Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading reports for April 3rd, 2016. We have a market that is in bull quiet mode. That's good for the long-term and short-term traders. On an annual basis, using weekly RSI 14, we're at the higher end of neutral at 59 out of 100. On a shorter-term basis, using 10-day NDX, we're overbought at 96 out of 100. Considering the market mosaic, price with respect to the 200-day moving average is green bullish at 3.69%, with a positive slope of the 50-day moving average, also green bullish at 0.98. ADX, measuring strength of trend, is increased to 22.8 with bulls in charge, but still not quite strongly trending, but moving in that direction. The threshold is 25 for that reading. Volatility continues to decline as measured by the ATR percentage, which is 0.84. The risk index is the 30-period moving average of the VIX divided by the 10-period. The threshold between risk on and off is 1.0. Current reading is 1.176, so we're well into risk on. When you compare that to the last 5,000 trading days, find the average and the standard deviation. We compute the risk Z score, which is at 1.94. Here you see a 90-day histogram of that indicator. We had 3 successive lower lows down to -2 sigma, and then an improvement. This movement from the swing low all the way up to this swing high has been about a 13% move in the S&P. That corresponds with declining volatility. We're now at 1.94, so it's rolled over at a 0.2 standard deviations above the norm. This is the place where we are ensuring that we are preserving profits, being very judicious about initiating new positions because of the greater than normal probability of a sideways choppy kind of a market as volatility has gotten to an extremely low level, and this is characteristic of a market that could become choppy. So we're looking for that. As long as it's above the zero line, that's favorable. But when it turns over at the end of a period of very quiet volatility like we have right now, that opens the possibility for some sharp retracements in what has been a sideways choppy market for the most part since the start of the year. We conducted our blended monthly rebalancing this week. These are the current holdings. The next reevaluation is due on or about 1 May. These are the holdings as of the close on Friday. Theoretical exposure in ETF2 is back up to 90%. The model portfolio itself will be at 90% with stops being adjusted upward. These are the holdings in the various BMR portfolios as of Friday. You can see Latin America and Brazil still dominating. In ETF Max, you still have gold at the top. We'll have to take a look at the biofuels here. Holy smokes. Quite a move. Brazil in various forms, Peru, South America, more Brazil. Even Russia starting to sneak in here. Some slight pullbacks in sugar. So some momentum plays that we can look to follow up on. In the S&P 500, Urban Outfitters is of interest, as are Mattel and Coach, Scripps, Applied Materials. Those would be ones where we're looking to see if there's additional momentum on the basis of 1 week of exceptional performance. The ones that are in red were large moves against them compared to their peers in the S&P 500. So Freeport, Moran, Consul Energy, Spectra Energy. These are all ones that had been doing really well and now have given back some. So that sets up a trade in either direction. It could either be continued momentum to the downside as the gains are locked in and preserved and the sell side takes over, or it's the pause that refreshes and people want to buy strength on a dip. Both of those frame out pretty well, and we have to look at the individual symbols to see if we have a critical state in either one, but that's on the priority list to do. In the market health check, you can see the vertical blue lines are 10, 20, and 30 days worth of look back. Here's the 60 and the 90. This is the swing high up here around 211 as our price target in purple. I want you to notice the slope of the 30-period regression line, which crossed the zero line, went down to here, and then started to improve. It started to improve because this section of price was no longer failing at the same rate that it was in this initial downward move. You can see that summarized by the dragon's move down. So this sideways price action is what enables the downward sell-off to slow down and stop, and that's why the slope of the 30-period regression line starts to improve up until this point where it crosses the zero line. So the slope of the 30 is positive right here, and that makes us ready for the transition into this move, which crosses the 200-day moving average and all the way up. Now, this is where that 30 peaked at a point 0.70. Anything north of 0.40 is an exceptionally strong slope, and so a little pullback here is natural. You see 4 or 5 days there and a couple days here, and so the slope of the 30 is still a very favorable 0.6. It's just not as steep as this was. This move, this 30-day move inside here, was as steeply up as it was in the top 3 of the last 10 years in terms of speed of recovery. So that's how fast this thing recovered. However, we are bumping into some resistance up in here. This would be the normal place to see that if we were going to get into a sideways channel, it would not be surprising to see that happen on or around the 200-day moving average. So a pullback into here would not be unusual. And you can see right now that the 30-day moving average, the middle of the river, coincides with the 200-day moving average. So that would be an absolutely normal kind of a move. Now, this large range day on reasonable volume on Friday was a vote for the upside, which would be a test at 211. So we would not be surprised to see more there. But also a turnaround here that would take it back down to 200 would not be surprising at all. You can see the jaws of percent price oscillator have closed, indicating that there's no such thing as easy money, but the easier money is made, and now it's sideways and kind of choppy. We've been overbought for almost 40 days, and so this is one where I'm looking to see how the market wants to move from here. Does it maintain these gains, find support above, say, 202, and then resume with another leg up and test the all-time high, or in as politically charged years is something that continues to oscillate within this plus or minus 12% band that we've seen since the start of the year? We shall see. ETF2, 9 out of the 10 sectors are on buy signals, 1 on cash. So that puts us at 90-10 invested versus cash in the allocation strategy. The S&P at 43 is better than the globals at 37, so it's still the U.S. leading the way. Inside the U.S., it's now the mid caps, then the large caps, then tech, and then small caps. Small caps have started to recover. For a while, they were the worst in the world. They are now back in the middle of the pack. So there's been some recovery inside U.S. small caps. That's a good thing for the U.S. In the sectors, the two strongest sectors, Latin America, Asia less Japan still. And the two weakest sectors should read Japan, excuse me, and the globals. Inside the sector spiders, strength remains in utilities and staples and technology. In the world market model, More of the U.S. is now above average. You can see all of the mid caps are, and all of the value is, along with the S&P 500. Still got a little bit of weakness in technology and in some of the small caps. Japan way below average. Asia less Japan above average. Malaysia, Thailand, Indonesia exceptionally strong in Asia. Latin America and Brazil continuing to dominate, as strong as anything on the board. The ETF top 30, based on the ETF2 lens, is showing basically the same thing as the blended monthly rebalancing, with new additions here of Brazil and Latin America. You see green and white shows that they've climbed all the way back to the top, and they're relatively newcomers to this exceptional group. Everything that's green on strength and consistency have been there for a longer period of time, continuing to do well. Of a special note is the 3M and metals and mining, exceptional. Here's the Dow report. Verizon remains at the top. Caterpillar's doing well on that, the resumption of materials. United Health, white and green. I really like that one on a swing basis. This is starting to show a little bit of relative weakness, so I'm going to be looking at that position carefully. Maybe a rotation from among the leaders here. All these that are in white and green used to be near the top, and now are maybe lagging a little bit. So Procter & Gamble, Chevron, Johnson & Johnson, GE, United Health, and Microsoft all fall into that category. 5 in the red. Boeing has really been bad, along with American Express. Although I will tell you, on a value basis, American Express has been giving us some good intraday plays as well, as maybe this is trying to find a bottom, and a changing of the guard and the ownership is underway. Shifting to the daily report. We have small caps on a short side alert on overreaction, so we'll be mindful of that. You can see here just how much volatility has drained out. We're now down in the quiet mode. That's using the ATR percentage, looking back over the last 100 days and applying statistics. Plenty of good auto framers to choose from. You can see the 10-day min pain. These are the candidates that have lost the least from their 10-day high, so there may be some momentum plays there. And then the 10-day max pains are the ones that have fallen the most from their swing high, their 10-day high, and Chevron, DuPont, ExxonMobil. That's normally where I do my hunting. One channeling signal here in Nike. Apple offering a overreaction short. A triple screen in Chevron. A bunch of 551Ws here. Boeing, Chevron, ExxonMobil, and DuPont. With Nike and Boeing being exceptionally interesting on the basis of being over 4-to-1 on their auto framer reward to risk ratio. ExxonMobil and Boeing both in the single digits on RSI2, which is quite often a sign of a potential turnaround short term. Lots of good fraud quality numbers to choose from. That's not uncommon when volatility starts to get to a low level. Inside the ETF 30, only one doji. Here's the overreaction short in the U.S. small caps. I would only play that one if I saw weakness in the market and IWM was doing worse than the S&P 500, and then I would look to play that intraday for as long as that trend continues. Got a couple 5DDs here in oil and commodities, 551Ws in energy, agriculture in Japan. Lots to choose from here on the auto framer, so that's looking pretty good, and quite a few also signaling on the RSI2. Key stats and price levels from the auto framer and things that test out better than 2-to-1. And in the regression line fractal framework, the top shelf in the green are the ones that are on a value play. These are the ones that are the most numbers of ATR below their own 270 period regression line for each of these populations. These in the red are the ones that are the most beyond their RL270. So these tend to be the relative strength leaders. When something's gotten 10 ATRs out in front of its RL270, I'm usually looking at that as something that is fully valued short term and is waiting for the longer term value players to catch up. Or it could be those guys are starting to sell some of those positions, their excess positions, to make some bank on the outsized profits. That would be normal harvesting of a successful season, and that's one of the things that can lead to a relative strength leader starting to stall a little bit. So we'll be on the lookout for things that are overheated out of that stack. Couple daily squeezes in Energy and Disney that test out better than 2-1. And the market mosaic. Now, what we've got to really pay attention to here is that this has been an exceptional 30-day run. From 192 to 208, 207. And that's almost an 8% run in 30 days. And the 30-period regression line, you can see, has crossed over its own 10-period at a distance more than one standard deviation from average. That's always been a warning to us about maybe a change in the weather. And you can see here over the last 180 days, when this changed, it went from big down to large up. When it rolled over here, it went from a nice strong up move to a sideways chop period for almost 2 months. So that's what I'm concerned about now, especially with price being very near the 200-day moving average, which is represented relationally by that red dotted line. And so this rollover led to a 4 sigma sell-off, which took it 10 to 12% below the 200. And then when this rollover occurred, this 4 sigma move is what has given us this most recent feel-good, exceptional 30-day period. Well, it's now started to roll over again. The last time it did that, it went from that period of outsized abnormal gains to a sideways choppy period, which was followed by the painful sell-off. So now that this rollover has occurred, I'm just concerned. I want to make sure that my bias is not towards the long side simply because we've just seen a great move. The odds are more with something that puts it into a quiet or a choppy sideways action, or even a reversion back towards the 200, as I've previously discussed. You can see these last couple moves now on a 10-year look back, and just how exceptionally strong those moves have been, and how much volatility has come in. It's quiet, yeah, too quiet. Some daily stats for you for the intraday guys. So I'm just going to flash through these. These are the reference sheets. Now the z-scores of the regression line slopes, you've seen this is the 30 that we've seen in a couple different forms already, normalized, and now we've added the 10 and the 90. You can see it, the 90 is sort of like the sine wave heartbeat here. It's coming back towards something like fair value and the long-term average. So that tells me that this big down move has been offset by the big up move, and now, again, the last time it did this, it just stalled sideways until the river caught up, and then it gave some fail signals, and then it had the big fail. So that wouldn't surprise me in this move here. If we can get above 210, then this is free and clear, and there's no resistance above. It's hard to see the justification for it, but crazier things have happened. In the 8th year of a presidency and approaching a very contentious, up-in-the-air election, the uncertainty, in my view, is more likely to produce the sideways chop than it is a runaway goodness, because the market hasn't priced in a winner yet. And there's enough divergence in their outlooks on the economy that more volatility would not be surprising. The frog lists, holding period framework, intraday percentage moves, quality reports, What I want you to notice here is just how uncorrelated from the S&P the Russell small caps have been. And because that's more of a function of trader outlook than the underlying health of 2,000 different companies. And that's why you see such an interesting divergence. And that just means that the small caps have not participated in that upward move to the same extent that the large caps have. So there is a perception of value difference in there in the minds of traders, which is still of interest since it's usually much more strongly correlated. My spider sense is telling me be alert for turns when the traders start to look at small caps as a value rather than as an excessive risk area. So we'll be on the lookout for that. All right, so that's everything I wanted to cover from the weekend report. Keep your risk measured and your powder dry.